everyone, good afternoon, especially to our beautiful instructor and to my co-future educators. Good afternoon. So this afternoon we'll tackle about inflows and outflows, and now let's begin.
But before that, we will know first the objectives. So understand inflows and outflows, and distinguish between cash inflows and cash outflows. Before that, we need also to know what is cash flow. So cash flow is a real or virtual movement of money. A cash flow in its narrow sense is a payment in our currency, especially from one central bank to another. The term cash flow is mostly used to describe payments that are expected to happen in the future, are thus uncertain and therefore need to be forecast with cash flow. So, cash flow is the movement of money in and out of a company. A company's cash flow is typically categorized as cash flows from operations, investing, and financing. So there are three activities of cash flows, which is operations, investing, and financing. So take note because we will discuss this later. Okay, cash inflow. Cash inflow is the amount of cash coming into your business. Cash flow includes gains you receive from an investments you made. Cash outflow. So cash outflow is when cash is moving out of your business. So cash outflow includes how much you spent on fixed assets as well as interest payment your business is required to pay for a loan you took. Difference between these two. Cash inflow is the net cash amount coming into your business that you have available for a period of time. Example, customer payments, return investments, and interest you receive on loans you have given to another entity. While cash outflow is the net cash amount that is going out of your business because you are paying someone else or another entity. Example, money spent on fixed assets, salaries, payment made to suppliers, loan taken and interest paid on the wages, transport costs, and insurance divided that require you to pay. As I said earlier, we talk about operating activities, investing, and financing. So first, operating activities. So, a revenue account, account payable, expenses account. So, in cash inflows, receipts from sale of goods and performance of services. Receipts from royalties, fees, commissions, and other revenues. In cash outflow, payments to suppliers of goods and services. Payments to employees, payments of interest, payments to taxes, payments for other operating expenses. So, in investing activities, non-current assets, notes receivable account, debt securities. So, in cash inflow, receipts from sale of properties and equipment. Receipts from sale of investments in debt or equity. Receipts from collections on notes receivable. So in the cash outflow, payment to acquire property and equipment, payment to acquire debts or equity, payment to make loans to other, generally in the form of rates receivable. Financing activities, owner's equity, withdrawals, note payable. In the cash inflow, receipts from investments by owners. So, receipts from insurance of notes payable. While in the cash outflow, withdrawals of the owner, payments to settle notes payable. This question, why is it important to understand cash inflow and cash outflow? So, anyone? Okay, very good. So in learning about cash flow can help people better understand to control their finances weekly and may be a better starting point for students struggling to make it to the end of the month without running out of money. Okay, thank you so much for watching, guys. God bless us all.